Are you a government bond? Because you're risk-free and irresistible. While we have been learning a lot about bonds, here's something we can't miss out on. It's government securities. But before that, hey everyone, this is Ria and I welcome you all to our knowledge series by SMES Discover, where you can get smart about investing. So let's get started. The GSEC market is the most active segment of the Indian securities market. Along with meeting the government's funding needs, GSEC debt market provides the benchmark interest rates for pricing of fixed income securities, structure fiscal policies, and is also an indirect channel for monetary policy transmissions. A government security or a state development loan in Indian markets implies a tradable debt instrument issued either by the central government of India or by the state government. Now, the types of instruments in the government debt markets are: number 1, treasury bills or T-bills. Treasury bills or T-bills are the short-term money market instruments issued by the Government of India at a discount to their face value. These are zero-coupon securities issued to be redeemed at par at maturity. Moreover, the RBI issues 91, 182 and 365 days T-bills on the behalf of Government of India and conducts weekly auctions. Now, the second one on the list is cash management bills. Cash management bills or CMBs mature within 91 days with non-standard maturity days. It can be for any day like 32 days, 56 days, 86 days, etc. This was launched in 2010 in order to meet the temporary shortage in the cash flow for the Government of India, as well as to absorb any excess liquidity in the system. Third one down the line is GSECs. The government securities issued by the government to fund its operations are called government securities, which have fixed coupon and redemption dates. The government securities are issued based on the issuance calendars in the month of March and September. Also, the expected size of auctions, the maturity, number of securities, etc. are informed to the market well in advance through these auctions calendars. The long-term bonds are usually referred to as the dated securities, and these are the largest components of Indian GSEC market. The Public Debt Office of RBI handles the issues and makes coupon payments and principal repayments on the behalf of the government. In fact, RBI is the depository of government securities as per the legal provisions. RBI plays the role of the merchant banker as well as the role of registrar and the transfer agent or RTA for the issues of the government securities. When the coupon payment dates fall on holidays, the coupon amount is paid on the next working day. However, maturity proceeds are paid on the previous working day. There are two types of bonds issued by the Government of India. First one is a fixed rate bond. These securities pay a fixed coupon over their entire life, semi-annually. For example, 5.77 GS 2030 was issued on August 3rd, 2020 and will be maturing on August 3rd, 2030. This 10-year security of 100 rupees face value pays a coupon at 2.8850%, which is the semi-annual payment of the annual coupon of 5.77%. The next one is floating rate bonds. This was first introduced by the Government of India in September 1995. FRBs pay interest at a variable coupon rate that is reset semi-annually. Mostly, FRBs are linked to the 6-month rate. An example of the benchmark is the 182-day T-bill rate. There are only 6 bonds with variable coupons, and one of these 6 is an inflation-indexed bond. Inflation-indexed bond. These bonds provide protection against both the principal amount and the coupons. In India, the first IIBs linked to the wholesale price index were issued in June 2013. In December 2013, IIBs linked to the customer price index were issued exclusively for retail customers. However, these bonds did not find wider acceptance and were discontinued after the initial issue. The Government of India had repurchased most of these bonds. The next one in the line are zero coupon bonds and capital indexed bonds. Zero coupon bonds do not pay any coupon and are issued at the discount while redeeming at par like T-bills. Currently, these securities are not favored in the market, whereas when it comes to capital index bonds, the principal amount is linked to an inflation index. RBI had experimented with a 5-year CIB issued in December 1997. Since then, there have not been any more issuances of these bonds. Next up would be bonds with the call and put options. The Government of India has also experimented with embedded bonds. The first such embedded bond with both call and put options, 6.72 GS 2012, was issued in 2002, in which the government had a call option while the investor had a put option on any of the semi-annual coupon dates from 2007. But currently, the Government of India does not issue any embedded bonds. Well, we have covered a lot of them, haven't we? So let's play a little quiz before we move forward. Can you recall which bonds are issued at a discount while redeeming at par like T-bills? I will wait for your answers in the comment section. Now let's move to the special securities. Occasionally, the Government of India issues bonds as compensation in the lieu of cash subsidies to entities like Food Corporation of India, oil marketing companies, fertilizer companies, also known as food, oil and fertilizer bonds respectively. In fact, the Government of India also issues bank recapitalization bonds under the special securities category. These are not eligible as SLR securities and thus pay a marginally higher yield over the yield of similar maturity GSECs. And going forward, let's discuss about the state development loans. Market borrowings of state governments through semi-annual coupon-paying dated securities are known as state development loans. In primary issuance, the auction calendar comes out every quarter just before the beginning of the quarter, and retail customers are allowed to purchase up to 10% of the notified amount. Well, that brings us to the last one, RBI saving bonds. These are specially issued for retail investors at par for a minimum amount of ₹1,000 face value and in multiples thereof. While these bonds have no maximum limit for investment, the interest paid is taxable. These bonds bear a floating rate of interest which is reset every 6 months. Talking about the legalities, the legal framework for the Indian GSEC market is provided by RBI's the Government Security Act 2006 and the Government Security Regulations 2007, with the amendments to these notified by RBI from time to time. CCIL is a payment system authorized by RBI under the Payment and Settlement System Act of 2007. That was all about the government debt markets. We hope you're excited to start your bond investment journey. Log on to smesh.in and take the next step towards investing. But before signing off, always remember, investment in debt securities are subjected to market risk. Read all the offer related documents carefully. Thank you.